Have you ever wondered why some people seem to have their finances on autopilot while others scramble with every bill? Here's the truth. Investing isn't a secret society reserved for Wall Street elites. It's your ticket to financial freedom, even if your starting capital is no bigger than a medium pizza budget. Intrigued? Stay tuned, because today, we're breaking down investing step by step, with real-life examples that might sound like your morning coffee run. Understanding the basics. What is investing, really? Investing means allocating resources, usually money, into assets such as stocks, bonds, or real estate, with the hope of generating profit or income over time. Unlike saving, where your money sits idle in a low-interest account, investing aims to grow your wealth by outpacing inflation. For example, with 2024's average inflation rate hovering around 3.5%, merely keeping cash in a standard savings account, earning 0.5% annually, means your purchasing power is actually decreasing. To combat this, investing allows your money to generate returns, historically around 10% per year in the S&P 500. This key difference is why many financial experts stress the importance of putting your money to work. Despite economic fluctuations and ongoing geopolitical tensions affecting global markets, the S&P 500 continued to exhibit resilience, demonstrating an average growth rate of 8.7% over the last decade. Such data underlines why consistent investing, even in uncertain times, can build significant long-term wealth. The power of compound interest. Compound interest is the process where the interest you earn on your principal investment also earns interest over time, creating a snowball effect of growth. This isn't just a concept for financial theorists. It's a proven wealth builder that has driven financial independence for generations. In fact, financial historians often cite Warren Buffett's journey as a testament to the power of compound interest. By investing early and letting his returns compound over decades, Buffett accumulated most of his wealth after age 60. Data from 2024 shows that individuals who start investing by age 25 can accumulate nearly double the amount by age 65 compared to those who start at 35, assuming a 7% annual return rate. A $1,000 investment growing at 7% annually will double roughly every 10 years due to the rule of 72. 72 divided by 7 equals about 10. By 2024, many investors who kept their funds in diversified ETFs have seen their portfolios grow substantially, driven by this powerful compounding mechanism, even amidst market dips. Choosing your investment vehicles, stocks, bonds, and more. Selecting the right investment vehicle can make all the difference in your portfolio's performance. Stocks have historically provided higher long-term returns, averaging around 10% annually for the S&P 500, while bonds are safer but offer lower returns, often between 2% and 5%. According to 2024 data, ETFs and mutual funds have gained massive popularity due to their diversified nature, which spreads risk across various assets. For example, the Vanguard Total Stock Market ETF has shown an annualized return of approximately 8% over the past decade, making it a go-to for beginners. Real-life perspective. If you're new to investing, starting with an ETF such as the SPDR S&P 500 ETF can be wise, as it mirrors the performance of the S&P 500 index, providing built-in diversification. Bonds, like U.S. Treasury bonds, have maintained their role as a safety net, especially in 2024, when the Federal Reserve's policy adjustments led to variable yields, but preserved their position as a hedge against stock market volatility. Getting started. Opening an investment account. Gone are the days when opening an investment account involved filling out stacks of paperwork and making calls to brokers. Today, online platforms like Fidelity, Vanguard, and newer fintech firms such as Robinhood and Betterment make the process seamless and user-friendly. Many platforms have integrated AI-driven tools that offer personalized investment advice, tailored to individual risk tolerance and financial goals. These tools make it easier for beginners to enter the market without feeling overwhelmed by choice. For tax-advantaged growth, consider opening a Roth IRA, where contributions are made with after-tax dollars, but withdrawals in retirement are tax-free. The contribution limit for a Roth IRA has been raised to $7,000 for those under 50 and $7,500 for those 50 and older, making it an attractive option for young professionals who anticipate being in a higher tax bracket in retirement. Diversification. Don't put all your eggs in one basket. Diversification is the cornerstone of risk management and investing. By spreading your investments across various asset classes such as stocks, bonds, and real estate, you reduce the potential for loss should one investment perform poorly. 2024 has demonstrated the importance of this approach, with tech stocks experiencing sharp declines during certain months, while sectors like energy and healthcare saw steady growth due to global economic shifts and innovations in renewable energy. A diversified portfolio in 2024 might include a mix of domestic stocks through an S&P 500 index fund, international equities to capture growth in emerging markets, and a bond ETF for stability. This strategy helps smooth out the bumps in your investment journey, ensuring that your overall portfolio remains resilient even when one sector takes a hit. Determining how much to invest. Deciding how much to allocate towards investments depends on your financial goals, risk tolerance, and current financial situation. While experts recommend aiming to invest 15% of your pre-tax income, even smaller amounts can accumulate over time. The key is to be consistent. According to a 2024 study by Fidelity, individuals who began investing 10% of their income in their 20s were projected to retire with 30% more in savings compared to those who delayed investing until their 30s, even if they invested higher percentages later on. If you earn $60,000 annually and invest 15%, $9,000, assuming an average return of 7%, you could have approximately $1.7 million after 40 years. This figure highlights the power of disciplined, long-term investing. Understanding risk tolerance. Know thyself. Your risk tolerance, how much risk you can comfortably take on, will guide your investment choices. Younger investors, with decades before retirement, typically have a higher risk tolerance because they can afford to ride out market downturns. On the other hand, those nearing retirement may shift towards conservative investments. Studies revealed that millennials are increasingly adopting a balanced approach, combining high-growth tech stocks with steady dividend-paying companies to balance risk and reward. A high risk tolerance might lead you to invest in sectors like AI or biotech, which, according to 2024 data, showed high potential but came with volatility. If you're risk averse, you might prefer bond ETFs or blue chip stocks like Apple or Johnson & Johnson, which have shown consistent performance despite economic fluctuations. Staying the course, the art of long-term thinking. Investing is a marathon, not a sprint. One of the most common mistakes new investors make is trying to time the market or reacting impulsively to short-term volatility. Historical data shows that investors who stayed the course during market downturns, such as the 2008 financial crisis or the COVID-19 crash, were rewarded with strong recoveries. The S&P 500, for instance, rebounded from its COVID-19 low of 2,237 points in March 2020 to surpass 4,700 points by the end of 2021. By October 2024, despite economic challenges, the index continued to show positive growth. The biggest winners in investing are those who remain patient. Avoid the temptation to sell during market dips. Remember, historically, the stock market has always trended upward over the long term. The role of dollar-cost averaging. Dollar-cost averaging involves investing a fixed amount at regular intervals, regardless of market conditions. This approach reduces the impact of volatility, as you buy more shares when prices are low and fewer when they are high. Many investors using DCA benefited from the market's fluctuations, purchasing more during temporary declines and gaining when prices rebounded. If you invest $500 monthly into an ETF, you might buy 10 shares at $50 each when prices drop, and 5 shares at $100 when prices rise. This method averages out your cost over time, providing a buffer against market timing errors and emotional decision-making. Continuous learning and staying informed. The investment world is constantly evolving, with new financial products, economic changes, and geopolitical events influencing market trends. Staying informed allows you to adapt your strategy as needed. Keeping up with Federal Reserve policies, international trade agreements, and technological innovations proved essential for many investors. For instance, the U.S. Federal Reserve's interest rate hikes impacted bond yields and stock performance, making awareness of such changes crucial for effective portfolio management. Utilize reliable sources such as the Wall Street Journal, Bloomberg, and investment-focused podcasts. Subscribing to platforms like Morningstar or attending webinars can help deepen your understanding and provide actionable insights to fine-tune your investment approach. That's all for today's video. If you found this video helpful and are ready to take control of your financial future, don't forget to hit that subscribe button and check out our other videos on personal finance and investing strategies. Join our community to stay informed and make smarter money moves. Thanks for watching, and here's to making your financial dreams a reality.